Here is your introduction to financial statements. What are financial statements? Technically, they are the formal report of the financial activities and the financial position of a business. The report is formatted in a structured manner for the financial statement users to understand. All financial statements are important, and the business activities of financing, investing, and operating are reflected on the four financial statements: the income statement, statement of retained earnings, balance sheet, and statement of cash flows. The first financial statement often addressed is the income statement. The purpose of the income statement is to show the net income or net loss during the year or the period covered by the statement. Income or revenue is shown first, and the related expenses are shown next. The difference is the net income or loss. Here is Marriott's income statement. Note everything is shown in millions. Here are the revenues and the expenses and the net income for the year. Take a note of this net income. It is the income that is kept or retained in the business at the end of the year. When we retain it in the business, it's called retained earnings, and we will see that number again on the statement of retained earnings. The statement of shareholders' equity is sometimes called the statement of retained earnings, and it shows the changes in those accounts over the reporting period. Again, note this is what happened during the year. Here's Marriott's statement. You can see the retained earnings is listed in its own column, and it is increased due to the net income that we mentioned, and it was from the income statement. It is decreased due to dividends given to the shareholders. Dividends are earnings from a prior period, and simply put, it's giving the owners a small piece of their earnings. The other changes to retained earnings are small, and they deal with change in accounting policies. Those changes are infrequent and discussed in the full intermediate accounting course. Now, the statement of retained earnings is the bridge between statements, as the income statement shows the operations of the organization, but doesn't show what is owned or owed by the organization. The statement of retained earnings shows the balance at the end of the year, and for our purposes, it's on December 31st. This is a set date, and the balance of those accounts on that date are transferred to the balance sheet. The balance sheet reports assets and claims to the assets at a specific point in time. The relationship among the categories on the balance sheet is referred to as the basic accounting equation of assets equals liabilities plus owner's equity. Within the accounting equation, assets are the resources owned by the business. Think of it as anything a business owns and controls in order to be successful with its operations. For example, a company needs supplies, inventory, computers, and office furniture in order to operate. Liabilities are the amounts owed to creditors, such as bank loans, car loans, or even credit card bills due each month. Stockholders' equity is what is left of the assets after paying the creditors, and it is the owner's claim on those assets. Here is Marriott's balance sheet. The first thing to know is the date is different from all the other financial statements. The other statements report on what occurred during the year, but the amount of assets and liabilities held by Marriott changes constantly, and they don't have day-to-day relevance since we have other financial information to give us what we need. It does make sense to show how much is owned and owed by Marriott as of the end of the year, so the balance sheet shows it as of the last day of the reporting period. Also note the amount listed in retained earnings is the amount from the statement of retained earnings, shown earlier. Finally, note the accounting equation. The total assets are identified, as is the total of liabilities and owner's equity. While it doesn't make sense to show the changes in all assets and liabilities over the year on the balance sheet, I did say we had other financials to provide the information. The statement of cash flows shows the beginning balance of cash and the changes in cash due to operating, investing, and financing activities. The statement starts with operating activities, and it shows the investing and financing activities. It also shows the cash at the beginning of the year and at the end of the year. This amount of cash is the amount of cash that is shown on the balance sheet. The interrelationship between the statements is important. The net income from the income statement is shown in the statement of retained earnings, and the ending balance on the statement of retained earnings is shown on the balance sheet. Additionally, the income, the balance of cash, and many other occurrences during the year that involve cash are shown in the statement of cash flows. In addition to the 4 financial statements, management of companies traded on the exchanges must disclose other information that might make a difference to the decision that users make. The first piece of information is the notes to the financial statements, which has non-financial details on what occurred and which accounting policies are followed. Other additional information is the management discussion and analysis section, which presents management's views on the company's ability to pay near-term obligations, its ability to fund operations and expand, as well as the results of its operations. The last information presented on all publicly traded annual reports is the auditor's report. This report does not pass judgment on the operations of the company, but it does tell the users if the financial statements are prepared in accordance with the accounting standards. In summary, the important things in this video are knowing the financial statements, the purpose of each statement, what's included in each statement, and how each statement is dated. It's also important to know the interrelationships among each statement and what additional information is included in the annual report.